What a day. What a day, everyone. Well, it's all over. The Russell Index is down 5.5%. The Nasdaq is down over 4%. The S&P is down almost 4%. This is pretty much the worst case scenario. But, if you got some cash in the account, then it's not maybe the worst thing ever. Cheaper prices on stocks. We're seeing a lot of nasty sell-offs here. Just looking at some of the stuff that's down today. Some of the retailers down massively. Wayfair down 25%. Big tech is down anywhere from 5 to 10% across most of the major names. So it's pretty ugly out there. This is one of the worst days that we've seen in several years. And I am buying. I'm nibbling a little bit. I think this is a tough day because I think it's tough to figure out what the near-term future really looks like here. Are we talking about a plunge into recession, or is this just going to be negative tariff news that gets reversed, in a matter of days? Maybe even in a matter of hours. So that's the question is like, do you update your prices, your valuations, your models for all these stocks to incorporate a recession and so a loss of earnings power, in which case some of these stocks aren't as cheap as they look, at least not as cheap as they look. And so that's a question. And of course, people will always ask, like, do I sell and go away for a while? Do I wait and to see how bad this gets? And, I think it's an interesting question at a time like this. There are a lot of unknowns and uncertainty. Typically, the way I try to navigate this is, as I've said before, I don't try to perfectly time the market. And that's just my approach. I think people are going to take this differently. Some people will feel more comfortable in cash, selling everything they own. Of course, if you sell everything you own, you're also going to probably generate some gnarly taxable gains and stuff that you've been holding a while. So that's another thing to think about. And I don't like to do that for that reason. And because I think, honestly, a lot of times moves like this tend to overreact in the short run. And they often do tend to be a buying opportunity. It's pretty rare that we just go straight into like a recessionary environment just directly off of a change in policy at the federal government level. This one is a little different. It does feel a little different. The scope of the tariffs, of course, are pretty massive. And so I don't want to discount the possibility of recession. I think a lot of people who are pro-tariffs here are saying, well, the U.S. for too long has been losing share in manufacturing. The structure of the economy is not sustainable. Certainly on the government financing side, it's not sustainable. And I think that's all pretty true. However, I think where I have issue with what we're seeing is the approach by the administration. So what I would like to have seen is a more controlled negotiation of reciprocal tariffs against specific countries, focus on countries like China and Vietnam, where you really do want to bring down trade barriers and reduce the outsourcing that's happening. I think if you do that and you get, particularly if you get breakthrough agreements like we had the USMCA, a number of years ago, we've had free trade deals with other countries. Those things tend to be a win-win-win. As opposed to what we're seeing now, which is kind of just a haphazard way of implementing tariffs across the board. It creates all this uncertainty for businesses and for consumers. And so what that does is that has a real effect on animal spirits in the economy. It certainly has an effect on what's happening in global markets right now as well. And the markets aside, I think the markets are one thing, but it really does. I think the ISM manufacturing report showed you that this uncertainty has a real cost, and this is the permanent cost that it can have. You could actually throw the economy into a recession, even if you reverse these tariff policies in the next, few months and weeks. And so like if you look at the manufacturing PMIs, and I showed this in my last video, but I want to show it again today because we had another ISM report that came out a few days back, and almost every single comment here, and these are business owners, almost every single comment is about the issue with supply chain disruption. Customers are pulling in orders due to anxiety about continued tariffs and pricing pressures. Business conditions are deteriorating at a fast pace, tariffs and economic uncertainty. So these are business owners, owners particularly of manufacturing businesses. And so I see a lot of people saying, well, this is going to be great for American business. We're going to reshore all this stuff. Okay, back off, because the owners of the businesses here are telling you that the way that the tariff issues are being handled is causing near-term uncertainty. It's causing disruptions in supply chains. And yes, eventually it may lead to some more onshoring, some more investments and investment commitments like we've seen out of TSM and Apple and a few other large companies. But that takes a long time to flow through. That could be 5-10 years before you reshore some of these areas of the supply chain. And some areas of the supply chain may never come here no matter what the tariff levels are, because you have other constraints, like for instance, in aluminum production. The reason that we don't produce that much aluminum in the United States is because energy costs are much lower in Canada, where they have hydropower facilities, and that's where a lot of the aluminum production for North America comes from. Now, you can't reshore aluminum production in a matter of months because, one, I don't think you're going to have low enough electricity prices almost anywhere in the U.S. Maybe if you can get a plant permitted near a nuclear plant, but is the land, is the availability there? Probably not. And then also, our company is going to commit to building massive factories when these tariff policies could get changed in a matter of weeks or months, or certainly if there's a new administration in a couple of years. So I think that's what I think the criticism is valid in my view, is that the way it's being handled, the assumptions that all of a sudden there's going to be all this new investment coming. In fact, what we're seeing from the rest of the world right now is that we're seeing, there was just a headline out on Bloomberg that Japan and South Korea and China were coming together to kind of create a coalition to try to work around some of the issues that are happening from the U.S. side. And so they want to form their own trade pacts. This is going to push countries further away from the dollar, right? These are really counterproductive moves here in the short run. Even if the goals longer term are to reshore, to create more fair playing field for the U.S., which I agree with, the way that it's being handled is causing just a tremendous amount of damage to the U.S.'s own economic position, to the dollar, to the stock market, to the potentially to the economy as well. And so that's where I think the administration has really fumbled here massively, massive fumble. And look, this isn't about politics. This is just about looking at the facts on the ground of what this means for businesses and for consumers and for the economy. So, there's a lot of different arguments online on Twitter, for instance, about like, oh, well, tariffs are inflationary, tariffs are deflationary. Look, it doesn't really matter. What matters longer term is, what's the overall impact on the U.S. economy and the global economy broadly. Because I do think you can have a little bit of inflation in prices near term, but ultimately this could be deflationary longer term, because, if you have an economy that gets thrown into recession, then you're going to have a big pullback in business investment, consumer spending, and all of the things that come along with that. So you could even get yourself into a stagflationary type environment, which is the worst possible environment for an economy, which is where you have prices on goods and services rising, but demand weakening, so volumes weakening because consumer spending is going down. And so that's the real risk here. And again, if you pull this back and you change your mind on all these tariffs, in a matter of days or weeks, maybe you can limit the damage, but overall, you're still going to have some damage to economic plans and to business investment, and you're going to push a lot of activity elsewhere. So that's really counterproductive to, I think, what the administration is trying to do. And sure, yeah, it's helping bond yields, but what good is it going to do to get the 10-year yield down if home prices collapse by 30%, or if the stock market values collapse by 20 or 30%? Because ultimately, this idea, Main Street versus Wall Street. Wall Street can take the pain while Main Street wins. Guess who holds the majority of U.S. stock market assets? Main Street. It's your teachers. It's your mom and dad's 401k. It's your own assets, right? It's your kids' assets. It's education savings accounts. It's pensions and endowments, and it's all these things that ultimately are held by individuals and families. You're not going to hurt. I mean, Wall Street may lose some jobs, but you're not going to hurt the trader at Citibank. That guy's going to still do well, no matter what the market's doing. In fact, volatility probably helps them. There's really not. There's a direct linkage between Wall Street and Main Street. You can send the markets down, but that's ultimately going to hurt Main Street a lot more than it's going to hurt anyone that's a trader on Wall Street. So I think that's just a really dumb argument as well. So let's just look in, after all this ranting about what's going on there, obviously in my view, let's just look at what's happening in the markets, because again, this is one of the worst days that we've had in a long time. And it's not surprising. And I do think we'll start to see Congress push back on some of these plans. I think you're going to have a lot of business leaders calling Trump here and calling the administration. I think you're probably going to see Howard Lutnick get booted out. I think you're going to see a change up in some of the advisors around Trump as they realize these policies are incredibly bad. And I'm actually pretty disappointed in Treasury Secretary Scott Bessent. I listened to his All In podcast interview a couple of weeks ago, and I thought, okay, it seems like he's got a fairly rational plan for pushing, trying to push more investment into the private sector and reduce public sector spending. And yeah, there's a little bit of pain there in cutting the budget, cutting federal spending. But then if you reduce taxes, you reduce regulations, then you can see a path forward for the private sector of the economy growing faster. But when you inject all this uncertainty and you have haphazard policies and you have these just massively aggressive policies put forward by the administration, then you're actually going to end up hurting private sector investment, right? So Scott Bessent, I think, has a lot to answer for here. I think there's a lot of questions I have over how he is handling all of this, and I think he deserves a lot of criticism here as well. So looking at the stocks, we've got, just a ton of different stocks that are down today. I am buying some select stocks. I am nibbling. I had about 50% cash in the 100K portfolio coming into today, which is still a pretty high level. I've been adding to positions that are really selling off hard, like for one, Wayfair. Wayfair, I think, is pretty compelling here. And I mentioned it in my last video that I did actually take a starter position in this a couple of weeks ago. And boy, it's down a lot already since then. It's down almost 30% today. And I am adding a little bit to it. Now, this is a long-term play. And I think it could also get a pretty big bounce off a 30% down day as well at some point here in the short run. But this is Wayfair basically trading back down to the lows it traded at in March of 2020 when we had the entire economy shutting down and there was a lot of uncertainty over COVID and what that would mean for the world at large. Is this that bad of an environment for Wayfair? Probably not. Wayfair in the interim over the last couple of years has had an interesting journey. It continues to grow revenues. However, it's been a very, very difficult housing market. And actually, Restoration Hardware reported their earnings last night, and they were quite bad. That stock is down 42%. Now, Restoration Hardware has its own issues. I've always kind of wondered about this company in terms of its management because, they're always flying their private jets and investing in really silly stuff. And they're just like a very lavish company. They buy back stock at high prices and all these things, and when they should be hunkering down and paying down debt during a tough housing market. Anyway, the stock's finally down a lot. You can see here it's down 41%. They missed earnings last night. Of course, the tariffs probably don't help them as well because a lot of their products get sourced from overseas, and so the prices of those products will likely go up. So either Restoration Hardware has to eat that margin or they have to pass on higher prices to consumers. So Wayfair is facing a kind of similar thing, although Wayfair serves a much lower end consumer. And so this is where I think actually Wayfair can continue to pick up a lot of market share. Not only are they picking up market share from brick and mortar furniture retailers, as they have done for the last decade, but I think they can pick up share as consumers look to retrench and purchase lower priced products as opposed to higher priced luxury products like Restoration Hardware. So I think Wayfair is in a pretty good position even if the economy weakens. Now, if the housing market takes a further dive, obviously that's not going to be great for volumes, but I think Wayfair can get through that period okay. And I also think on a longer term basis, Wayfair is taking a lot of interesting steps to increase margins. So for instance, in the last 6 months, they announced that they're shutting down their Germany business, which was loss making, and they couldn't really see a near term path to profitability. They've been cutting headcount. They've been terming out their debt. So they just refinanced some of their debt. And so they, that's all good because it gives Wayfair, a lot more longer term opportunity to continue to generate not only higher revenues, but better margins, better cash flows, pay down debt, and the stock I think will look cheap on a longer term earnings power. So, in a couple of years, I think the company could be producing $500 million or more of free cash flow. And today I think it's trading under a $3 billion market cap. Well, it's about 3.2 as of right now at $25 a share. So I think it was around 3 billion total market cap there earlier when it was trading under 24. So I do think, you're paying basically 5 or 6 times what I think will be normalized free cash flow for Wayfair. And I think they can grow a lot longer term too as a category leader in online furniture in the North American market. They do compete somewhat with Amazon, somewhat with Etsy, somewhat with other furniture sellers, and then of course brick and mortar. But online continues to eat brick and mortar share over time, just as it does in every other category. And so that's one of the things I like about Wayfair. And again, I think they're quietly taking all the right operational steps. They're also opening brick and mortar stores. They opened their first one last year in Illinois. And that's kind of interesting because it's kind of similar to IKEA. It gives you a showroom, it gives you a brand bump, and it gives you a physical location to be able to try different things and show consumers different things. And so I think that they have said that leads to an uplift in not only the brick and mortar sales, but the online sales in that region around Chicago. And so they're gonna start slowly rolling out some more brick and mortars as well. And I think that'll be good for them. So stock down, almost 30% today feels like a little bit of an overreaction, especially because, on a 1 year basis, the stock is already down, it was already down like 40%, 50% before this most recent gap down today. So, yeah, I think that's an interesting one. I'm going to poke in here and look at the comments because I should have been watching for that, but I wasn't. So apologies. Let me just open up another window here. By the way, how are y'all feeling today? Are you feeling like fearful? Are you feeling like you want to deploy capital? Like what's the vibe out there? I know it's probably pretty rough for a lot of people looking at their portfolio values. Certainly mine's down today. I can pull in the values here. It looks like, yeah, sitting about at 102.5 on the 100K portfolio. I'm still up overall since last fall, and actually I think the gap versus the S&P is pretty nice. I think it's about a 10% outperformance versus the S&P since I funded this portfolio. But of course, a lot of that has to do with just being heavily allocated in cash. And then also I had that great Alibaba call option trade to start the year, which I exited a couple weeks ago, which was pretty good timing on that. Interestingly enough, Chinese stocks are showing a little bit of relative outperformance today. Some are down, some of the more risky ones are down, but overall we are seeing like Alibaba, for instance, is down less than 0.5% today versus, you look at the US big tech, let's just pull it in here. Apple down 8%, Amazon down 7%. I did buy a little bit of Amazon today. Meta down 5.5%, PayPal down 7%, Tesla down 5%, TSM down 6%. Let's see, who else? I mean, Google's down 3%. Google's had a pretty tough year so far. There's a lot of longer term questions. I tweeted about this the other day. A lot of longer term questions about Google's competitiveness, particularly in its core search business. Like, is it losing share to Perplexity and OpenAI's ChatGPT and all these other LLM products? It probably is losing some search volumes already. And the question is, what does that look like longer term? Even though Google's rolling out its own Gemini products and starting to get more aggressive on the LLM side, which is good. The question is monetization. Like, obviously, they're probably going to long-term insert ads into the LLM interface for people that want to use it for free. But there's a lot more competitors in the LLM business than there is in search. And we don't know if they can monetize at the same rate with LLMs that they can in search. So it's kind of a big question mark there. Now, we saw a similar question mark with Facebook when mobile popped up. And in the early days of mobile apps, Facebook was pretty slow to roll out their own app. And there was a big question about, hey, they monetize ads really well on desktop. Are they going to be able to monetize on mobile? Of course, we now know that mobile's become the big revenue generator for Facebook, particularly after they acquired Instagram. And they were able to very smartly weave in a lot better ad formats actually in mobile than they ever had on desktop. So sometimes those questions can become actually big opportunities. And that's maybe what could happen longer term with Google. But there's a lot of uncertainty there. And so I think Google's been suffering from that. Now, Google's got some other interesting assets, right? Like Waymo. Waymo getting a lot more aggressive in rolling out autonomous vehicles. I think maybe they should try to spin that out when the market gets better again and try to do like a spinoff and see if Waymo can stand alone as a public company, because I think it would get a pretty high valuation and they could raise a ton of capital, which they're going to need for the rollout of AVs. Maybe they're a little scared to do that because the AVs are losing so much money today, but nonetheless, I think there's a big opportunity with Waymo. And then, of course, Google owns this platform, YouTube, which is like the basically the dominant video platform on the internet and really competes it really even competes, I guess, in some sense against the Netflixes and the streaming services of the world. I'm sorry, I've got a kid screaming back here. There's nothing I can do about that, but you know how it is if you have kids. So, yeah, I mean, I think it's I think it's today's just a little bit scary just in terms of the uncertainty. But again, I think we all have to kind of raise our probabilities of recession. But you can already see that a lot of stocks are front running it, right? So like when you have a stock that falls 30%, how much is it already pricing in a potential for recession? And that's kind of what I have to ask myself, especially if you're sitting on a lot of cash like I am in the 100K portfolio. You can't be totally afraid to deploy at some point. There's that phrase, scared money don't make money. And I think some stuff will probably have short-term bounces too that are tradable. I mean, look at some of these retail stocks. I think Deckers, which has been down every week for the past like 10 weeks. It was down at 97. It's now at 101. I did buy a little bit of this today for a bounce play. But you can see the whole retail sector is down big. But starting to trade down to what look like potentially defendable valuation multiples. Like, let's look at the earnings estimates. And again, we might have to adjust our estimates for earnings here if we do go into a slower consumer spending or even recessionary environment. Like, they're not going to earn $6 or $7 a share in 2026. They might earn like $3 or $4 a share, right? So we kind of have to reprice our earnings estimates a little bit. But let's say a normalized earnings for them through the cycle, kind of mid-cycle, looks more like $5 a share. When you're trading at 97, well, you're trading for less than 20 times earnings, which is a pretty low multiple for Deckers, which has been taking share in the industry. So, again, sorry about the background noise. Hopefully they figure that out soon enough. I'm gonna I'm gonna have a separate office at some point here in the near future as well, but today is not that day. Anyways, you can see Deckers, if we look at like a long-term valuation multiple, particularly, in recent years, I would say in the last decade especially, this thing has rarely traded down to a mid-teens earnings multiple because it is a share gainer. Brands like Hoka have been taking share from even bigger brands like Nike. So you've got a pretty low historical multiple here now on Deckers. Again, I think maybe you adjust earnings a little bit lower to account for the the potential for recession. But even there's a defendable level at which I think you can buy some of that. Nicola, the kid was all in on S&P 500. I think that's why he's so upset back there. He's looking at the market action, and he's upset. What else? So I got my shopping list here on TradingView. I have a bunch of different watch lists. We can go through different ones if you want to look. But the shopping list, I'm kind of just sorting by what stocks are down the most today. Interestingly enough, I do own some First Solar. It's been a terrible performer over the past few months, but they're actually potentially a tariff beneficiary if a lot of these tariffs stick, because you have they're basically the only domestic producer of solar panels at scale. So I think that's certainly why we're seeing this one trade on a relatively stronger basis. Oscar Health, this is kind of an interesting one. I've been looking at this one. I've owned a position in this one before, but healthcare, and especially like cheaper value price healthcare stocks, are an area that are showing some relative outperformance today. Tend to be a little bit of flight to safety stocks as well when we get big market sell-offs. So those could be interesting, particularly Oscar, which is down a lot in the last couple of months, even though they've been growing revenues at like 40 to 50% a year for the last couple of years. So that's pretty interesting. Now, there's big questions over the future of the Medicare Advantage program, which could be a hit to Oscar, and that's why the stock is down over the past year. But you've got the potential for them to keep gaining share in terms of their U.S. healthcare consumer base, because they provide one of the better consumer experiences in healthcare. They also offer pretty interesting platform that's like AI enabled. They do a lot of telehealth, so they're kind of like the newest U.S. health insurer that's been launched in the last 2 decades, and they've been gaining some share. So that one could be interesting at a certain point, but showing some relative strength today. Some stocks that are already beaten up a lot, Bumble, like in the dating space. I mean, this has been a terrible, terrible stock, but it's trading for like 3 times this year's free cash flow estimates. So how much downside is there when the stock's already bombed out? That's a good question, right? Biotech has been super bombed out. So I'm starting to look at names like CRISPR Therapeutics. It's down today, but not down a ton, because again, this is a stock that's already been hammered over the past year. Like the whole XBI biotech ETF, you look at this thing, it's been pretty brutal brutal. Like, let's look over the past 6 months. This thing has been almost straight down. It's down almost 20%. And this is an ETF. This is a broad basket of biotechs. Yesterday, I did a screen. I found over 100 companies, biotech companies in the US that are trading for less than the net cash on their balance sheet. Now, a lot of those companies are burning cash right now, going through phase trials. But one interesting component here is that, or one interesting potential driver is that we've got new heads of the FDA, and then there's new people being put in that want to reduce regulations on the pharmaceutical drug development pipeline. So that could actually be a big boost to the biotech sector at some point. TBD on that, of course. Then you've got, stocks like Etsy, which I own a little bit of, that, again, just bombed out companies that are going to be down a lot less on a day like today. But when you look at like a lot of these high flyer tech stocks, they're still getting creamed. Energy's getting creamed pretty hard today, which is understandable when the market's looking to potentially price in a higher probability of recession. That means a lot lower oil demand if we do get a big pullback in consumer spending. However, there is an argument to be made that if you go into a stagflationary environment, that energy stocks could do well. I'm not adding to energy today, but I potentially would if we got a deep enough sell-off there. Again, I think the biggest carnage appears to be kind of in retail and tech. You also do have some big carnage in banks and financials, which I think could be another interesting area to fish for some stocks, because you've got some pretty cheap multiples now, particularly on banks like Citigroup or some of the European banks, where you actually have you've had a positive inflection. Look at like Santander and Barclays. These were banks that were still trading at low multiples of book value just a couple of months ago, and then you had that big trade where you had a shift into European stocks out of US stocks, particularly by European asset managers, and that's a trend that I think could continue, and that benefits some of the big European banks. And the European or the ECB and the EU have committed to higher deficit spending. Even Germany's committing to a higher deficit spend here, so that's pretty interesting, because now you flip from what was not a very strong fiscal spending environment in Europe to having a lot more fiscal spending support, and that could benefit the stock markets there. And so European banks may be the baby thrown out with the bathwater here. You could have an interesting story setting up here in some of the European banks on this pullback. So that's another area to look at. Even something a more global bank like Citigroup, which is down 10% today. I think it's trading for around 0.7 times tangible book value, around 10 times earnings. That could be interesting. Perhaps even some of the U.S. banks or credit card companies, you're going to have some concerns about rising consumer delinquencies. So maybe you let this one fall a little bit further. But overall, they're in pretty good shape. They've really increased their lending at higher credit scores in recent years, and so there's I don't know. There's a big question there, right? If the stock market sells off enough, people probably do start missing their credit card payments even at the higher income levels. But maybe if at a certain price, if these got back down to 6-7 times earnings, that those could be interesting. I'd probably steer away from those in the near term personally. I'm probably, again, looking at more of the global diversified banks, particularly ones with European exposure outside the U.S. I think those could perform better on a relative basis for the rest of the year. So that would be something to consider on the banking side. But again, banks are pretty levered, and so that's always a risk. I think for me, I got to keep my position sizes small on banks in particular, because as we saw in the global financial crisis, there's so much leverage in banks that they could be washed out very, very quickly. Anything with leverage, for that matter, like any industrial companies or companies that have high leverage on the balance sheet. Again, I think Restoration Hardware is an example. Like today, down 40%. They have a pretty ugly balance sheet. Anyone who's levered is going to be, I think, in trouble if we go into a deep, deep recession. So, that's just kind of what we're looking at today. Let's take a quick look in again at big tech. Big tech maybe coming off its lows here. It looks like a little bit, which I did expect. So we've got a pretty nice recovery here. We'll see what happens. I'm surprised that Tesla's not down more. I know that Tesla is perceived as a winner here because they have a lot of domestic U.S. production, but we cannot forget that their largest factory, or one of their largest factories, is in China. and they would be the target of retaliation potentially by China. They could also, of course, they've had 30 to 40% volume declines in the sales of Teslas in Europe so far year to date, and I think that that could continue. You have retaliation potential. Let's just look at their deliveries report. Their most recent deliveries were well below expectations and were down significantly year over year. Some of that had to do with the switchover in the Model Y. They're making a cheaper Model Y version, so it takes them, a month or so to switch over. So they stop production of the old version to make production of the new version, and that creates this gap of time where there's just not as many vehicles for them to produce and sell. So that's part of the story. But in some areas like Europe, where they had plenty of supply still, they saw a big decline in sales. Part of that has to do with disdain for Elon and disdain for the US coming from Europe right now. Part of that has to do with other competitions from EVs that are being launched by other brands. So the EV market's getting more competitive. And so, yeah, you see here that deliveries were only 336,000, and that was versus the Q1 last year of, what was the exact number? I forget off the top of my head, 386. So 336 versus 386, it's basically like down almost 20%. So that's a pretty significant drop in Q1 deliveries. And the hope, of course, for Tesla is that those numbers improve throughout the rest of 2025. But if we're going into recession in the US, which again, I don't think it's a given, but certainly there's going to be some pressure, I think, on consumer spending in the near term. I think that pressures Tesla's US sales, even if Tesla vehicles become cheaper on a relative basis to, say, BMWs or Mercedes or other EVs. Tesla's not alone in the US. Like Ford produces vehicles in the US, GM produces vehicles in the US, Stellantis produces vehicles in the US. So these companies are still going to compete. You're still going to have competition from, other brands, and you have consumer spending pulling back, and you've now pissed off the Europeans and the Chinese. And so I think on the auto side of the business for Tesla, they're in a pretty tough position here near term. Of course, now you got to get into the discussion about robotaxis and about humanoid robots, because that's the big thing. That's the reason why Tesla trades, at a market cap that's greater than the sum of every other major automaker. And if you don't believe me, and I think this is still true, let's just pull up the auto watch list here on Coinbase. Yeah, if you've never used Coinbase, it's a super good platform. I have a referral code in the description of all my videos for it, because I just love the product, frankly, and you can get like a 20% discount on a subscription using the code that I've got in the description. But this is the platform that I use for just quickly pulling up things like screens, financial information on companies, valuation charts, and earnings estimates. A lot of stuff related to fundamental investing research. So here you can see Tesla today. Call it an $870 billion market cap. And if you look at the sum of all of the other major automakers that are publicly traded, Toyota, BYD, Volvo, Volkswagen, BMW, GM, Honda, Ford, Stellantis, which is Chrysler and Jeep and all those brands, Hyundai, SAIC, Suzuki, Geely, Renault, Nissan, you add up all the market caps of those publicly traded automakers, they add up to $806 billion. So Tesla still today trades for a market cap that's greater than all those other automakers. And so when people say, well, Tesla's all about the future, they're all about humanoid robots, they're all about robotaxis, the current car business, the EV business doesn't really matter as much. Okay, well, you're already pricing in a pretty bright future for Tesla. So, can Tesla become a $3 trillion market cap company if they're producing humanoid robots and selling tens of thousands of them? Yes, they can. But you're already pricing in a lot of that on a present value basis. And by the way, if they don't hit their targets, if they don't roll out the Robotaxi business in a smooth way, they're talking about a June launch here in Austin, where I live, for the Robotaxi service. I'm definitely going to be testing it and hopefully showing some examples here on YouTube. If they do not do that in a way that is well received, if they have too many accidents, especially relative to, say, a Waymo or other companies that are launching, then you're going to have a real problem, a narrative violation with Tesla that could dent the valuation, 30, 40, 50%. Because again, there's so much premium already built into the market cap for the non-auto businesses already that's my concern with Tesla. That's why I think, like, for me, like, I bought a little bit on the dip a couple weeks ago, and then I pretty quickly sold it. I was looking for a bounce. I didn't get a huge bounce. I like bought it here and like sold it here, which was pretty stupid. Look, I make the same over trading mistakes that we all make sometimes, but it did get a bigger bounce a couple of days later. But I really, for a long-term position, don't want to own this until it's probably closer to $100 a share, I'll be honest. And that's a long way from here, but I think there are scenarios where it gets there. That scenario, I think where it gets there is they keep missing delivery numbers in 2025 in the car business. The car business weakens. The Robotaxi launch has either some issues or just isn't as smooth as Tesla hopes, or, you know, let's say regulatory issues come into play. Let's say there's a couple accidents and a bunch of cities and states decide that Tesla has to do a bunch more stuff before they're able to roll this business out more broadly, right? And then it becomes a 2030 type of launch timeframe instead of a 2025 launch timeframe, right? If things like that happen, there's still significant downside in Tesla stock in the near term, and that's my concern. And again, that's why I'm kind of surprised it's only down 4% today after this pretty ugly deliveries number, and the fact that I think there's potentially some more brand damage from Elon Musk's association with the Trump administration, which is getting itself into some real pickles here with the rest of the world. Now, the positive thing that I saw this week on it was that Elon is stepping away from the DOGE effort. And that, I think, is obviously a good thing. I don't think he's been that involved on a day-to-day basis lately anyway. But DOGE is interesting because, you know, they had originally targeted $1 trillion of savings. This number has only gone up from about $100 billion to $140 billion in the past 3 or 4 weeks. That's kind of concerning given the fact that, you know, they're targeting $1 trillion, and it doesn't look like they're going to get anywhere close to that. And with Elon stepping away here in a couple weeks, maybe that's good for Tesla and his focus on Tesla and SpaceX and his other companies. When it comes to this whole narrative around cutting the budget deficit, this is not going to be that big of a swing. If it only ends up being 200 billion, 250 billion this year in 2025, we're running a $1.7 trillion deficit right now. And there's potential for that to actually expand if we go into recession, or if we have, you know, a tax cut that's passed this year. So that, you know, that's interesting, right? That's another aspect to the story, is like, is he not delivering on another promise, like the promised $1 trillion savings? If that doesn't come through, you know, that kind of dents his brand as well. Even if he's able to return more focus to Tesla and spend more time there, which is probably a positive overall for Tesla. I wonder about the DOGE and what in the, you know, the DOGE efforts and what that really means for Elon longer term. Like, did that do more damage to him than it helped, you know, the U.S. budget deficit? That's kind of, I don't know, just something I've been thinking about. But a little bit disappointed, honestly, to see that they're only at 140. Given the fact that they were at 100 just you know, a month ago. They were at 100, and it looks like the savings have slowed down, and there's some questions as well about this, if this number is even accurate. So obviously I think that a lot of the things that they're trying to do there are very positive. I'm a huge believer in trying to cut out a lot of the, you know, just excesses and fraud and abuse in the government spending. Because that's actually, you know, I will say on the All In podcast, Howard Lutnick and Scott Bessent had some great comments about that, which is like, you could actually, if you cut out a lot of the fraud and you cut out a lot of the money that's being spent outside the U.S., you can cut the budget deficit while not having a major negative impact on the U.S. economy, on the domestic economy. So that was something that I thought was a huge potential positive. So I wish we would see more progress there, but you know, maybe it comes in a lot of fits and starts. So hopefully DOGE continues to provide a lot of, you know, a lot of effort there, and maybe we'll see more progress down the line. All right, so let's talk some more stocks. Yeah, Goog is attractive at 17 times earnings. Yeah, again, I think the question there is like, can you truly believe and get behind the search business not declining? Losing share to LLMs and losing monetization to LLMs, because there could be a couple years period, even if LLMs end up monetizing at the same rate as you know, as the search business, it may take a few years for that monetization to get there. Like, remember what happened to Paramount and WBD, right, in the streaming business? Like, these legacy streaming businesses that have a lot of their revenues and profits from cable have been a disaster. Paramount Global is getting acquired right near the bottom for a super, super low price. Warner Brothers Discovery stock has been in the tank for years. And that's because even though they're shifting their business to streaming, that streaming business is way less profitable than their core cable business. And so there's going to be at least a few years potentially here where if you shift from a lot of search volumes to now people using LLMs in lieu of search, at least for some stuff, monetization can really decline even if eventually they're going to get back to where they were. There can be at least a few year period where they just get absolutely crushed. And so the question is, for me, the biggest question is Google search going to decline? Now, they're not declining right now. You look at Q4, they continue to grow their search business. And of course, they're growing in YouTube and they're growing in Google Cloud as well. And those are real nice bright spots in the business that are still growing. And then, like I said, you've got the Waymo asset, which could be interesting in the other bets. That could scale up quickly as well. But in the core search business where you derive almost all of your profit today, if that starts to really decline at some point, that becomes a situation where Google maybe is a little bit of a value trap. And you look what they did with Wiz. Wiz, I think this is really embarrassing for Google. Google is spending $32 billion on a cybersecurity business called Wiz, which only produces around 500 to 700 million of annual revenue today. Now they're growing at 30 to 40%. But the problem here is that by spending more than 40 times revenues on this company, Google is giving up $32 billion of cash, which could have been used, in my view, to massively accelerate Waymo's rollout and lead, or invest more heavily in the data center projects and the AI products that they need to really get working quickly. Instead, they're spending $32 billion to go acquire a company that I don't think is actually financially giving them very much at all. This is one of the most expensive acquisitions and largest acquisitions Google's ever made. It's one of the most expensive SaaS acquisitions I've ever seen. This is one of the most expensive, from a valuation perspective, acquisitions that I have ever seen at this scale. And I think they're setting themselves up for a massive, massive write-down on Wiz. So you're going to have a massive write-down on Wiz at some point. There's a big question about Sundar's capital allocation abilities here. I don't think Sundar is the right person to be running Google during this wartime. You need a Mark Zuckerberg type figure who moves quickly, who moves aggressively, who cuts fat, who cuts expenses during a time when there's a big question about the core search business. So I do think Google looks cheap optically, right? It's down to, if you believe the analysts' earnings estimates, it's trading for, again, I think you said 17 times, which is about right, because this year the earnings estimates as it stands today is $9 a share of earnings, which means Google's currently trading at about 17 times earnings. I think they can probably hit their earnings estimates for this year unless we go into a steep, steep recession very quickly, which again is possible, in which case you're going to have a pullback in advertising spend and they probably can't hit the $9 estimate. Maybe they only do $7 or $8 of earnings in that case. So it's maybe even a little bit more expensive than it looks if we go into a deep, deep recession. But excluding that, assuming that the Trump administration pulls back quickly enough to not plunge the economy into recession, trading at 17 times. But then I don't believe this $10, $11 earnings estimate for 2026 and 2027 at this point, because I think search is going to come under pressure. I think you're also going to have a situation where if they do accelerate the data center build outs for AI, that CapEx, which they're planning already to double this year, that's going to create a huge depreciation headwind on the income statement. That's going to create a headwind for earnings growth. I think you're also going to have potential for the Waymo. If they keep Waymo in-house and don't spin it out into an IPO, that could be another earnings headwind. If they're going to aggressively invest in Waymo, that's going to cost a lot of capital as well to build that business out. And that's, again, why I don't think they should have paid $32 billion for Wiz. Google needs to be hoarding all of the capital. Now, it looks like Google has a ton of cash on the balance sheet and they generate a ton of cash every year. That's true. But if that capital starts to decline a little bit because of, again, the core search business starting to pull back or economic headwinds, they're going to need to conserve cash. I mean, Google's already, again, committed to all of this massive AI spending, all the Google Cloud CapEx, and I think they made a huge, huge mistake acquiring Wiz at $32 billion. So, man, Google's a tough one because I do think it's probably optically cheap. It probably gets a bounce, but you've got a lot of headwinds and issues to work through. So I don't think you're going to get Google trading back at 25, 30 times earnings anytime soon. I think it's going to perpetually trade for like 15 to 18 times annual earnings estimates, and until they prove that, until they really honestly get through this big investment period with AI and prove that they're not total losers in AI. Again, I think they do have some good assets. Like YouTube is an amazing asset for them to own and will continue to grow and spin off, good cash flows. But there's just a lot, and Waymo has potential too. Maybe even if they IPO Waymo and they put the capital intensity of Waymo into its own company and then fund it via share issuance in public markets, that's I think a much better path to market. My God, there's a lot of screaming out there, and I apologize if you can hear that in the background. I can hear it through my headphones. It's crazy. So yeah, I think there's a lot of just interesting questions around Google. I think it's probably cheap enough at 14 or 15 times earnings. Even at 17, I'm starting to think about nibbling a little bit. But if you're buying it at 17 times this year's earnings and we go into recession, you might be actually buying it at 20 or 22 times. And then if you have questions on top of that about the long-term, threats to search business, I don't know. Could it trade down even further? I think it could. You have to be prepared for that possibility. Yeah. Mystic Max says, I think you should do more research before you do the videos. You're wrong on Google. Okay. Yeah. Tell me. I mean, I'm happy to admit when I'm wrong for sure. I'm sure that I'm missing some things on Google. Please tell me what are the major things that I'm not talking about here with regard to Google that you believe to be true that I'm not getting here? Because we can look at the numbers, we can look at, analyst estimates, we can look at, the actual lines of business from a, operating perspective. Like if we pull up, again, we could pull up operating profits, we could pull up, different breakdowns of how this business grows from here or doesn't grow. You tell me where I'm wrong. Tell me where you're more optimistic. Hey, sorry, y'all. I got to take a quick break. There's something going on here. So I'll be right back. I'm just going to mute real quick and go check on things over here. All right, I'm back. Spoon's mentioned in Wiz is thought to make Google Cloud a more attractive part of the Google Cloud business. Yeah, I guess. So my thing with that is, like, a few years ago, Google bought a business called Looker. Looker was considered to be like the best business intelligence platform out there. And, so if a business intelligence software, like if you're essentially mostly it's used for visualization or running queries against, large databases when you're trying to mine data in your organization. Let's say you've got a retail business and you want to figure out what customers are spending the most, or how are our user acquisition campaigns doing, what channels are delivering the highest ROI, and you have all this data from all these customers coming in and clicking and buying, and you want to essentially mine that data and look at, basically cut up different parts of the data and figure out different insights from the data. That's why you'd use a BI platform. So companies like Salesforce, companies like Looker, Looker was considered one of the best business intelligence platforms. And then it kind of and Google bought it and put it into Google Cloud to be kind of their business intelligence software. But it sort of just lives on its own, and it's not really, it's like Google, I think it's Google Data Studio that's used more often now. They push that more often in the Google Cloud platform. So Looker's an example where they bought a really best-in-class platform and put it into Google Cloud, and then it sort of has just not really gone anywhere and hasn't really juiced the growth rate of Google Cloud that much. So I kind of wonder the same thing about Wiz. It's okay, so you buy Wiz for this massive price and you put it into the Google Cloud business. Does it actually attract new customers to Google Cloud? And so I don't know. I don't know the answer to that, because it's just it's a very niche specific product that's focused on cybersecurity. And I guess maybe if you roll it out as your layer of security over your entire cloud, but they already have authorization services. They already have cybersecurity built into certain components. They already have, different layers of what I would consider cybersecurity. So like, does it generate incremental revenue beyond what you would have already gotten from Google Cloud? And that's I don't know. That's a question I'm not sure if I fully buy it yet. I could see something like, better AI tools being weaved into Google Cloud being a much bigger driver. Like Microsoft, for instance, is getting a lot more Azure interest because they're like, hey, we're building like LLM capabilities in, we're building in Copilot, we're building in all these other AI products on top of the Azure cloud to make the whole cloud business just much more capable. And so that to me is like that makes sense. Like I think if Google had some product where they could roll out LLM capabilities more broadly across Google Cloud, that's going to get you a lot more people interested in using Google Cloud servers and Google Cloud databases and Google Cloud whatever than a very specific niche thing like buying a business intelligence software or buying cybersecurity software. Like, yes, cybersecurity software is like its own niche vertical, but I don't know that it gives you a lot more incremental customers versus what you would have gotten anyway in Google Cloud. I think Looker is an interesting use case or an interesting example case there where it's like they bought this vertical thing saying that it was going to help the overall Google Cloud universe, but it looks like it didn't really do much for them. And so that's kind of my concern with Wiz as well. But maybe they do a better job with Wiz. Maybe it does attract more customers to Google Cloud who were like, okay, Google's not as security conscious, or Google doesn't have as deep of a platform that alerts us when there's security issues. Maybe that was a need that people kept calling out on the enterprise side that they didn't have enough capability on. So that's possible. I hope that I'm wrong about the Wiz acquisition. It's just the price they paid is just so high. So yeah. And look, Justin's right. Google has historically had a really, really good track record on acquisitions. Like, let's just Google. I think I've pulled up some graphics on this, but like, if you look at the best corporate acquisitions of all time, a lot of the ones that are cited are actually Google acquisitions. Like, so Google obviously acquiring Google Maps was huge. Google acquiring Android was huge. Google acquiring YouTube for like, I think it was $1 billion or $1.5 billion has been just one of the best returns of an acquisition ever. And then of course, Google's original search business came out of a product called DoubleClick. And so those were, basically Google has what, four out of the top 10 best acquisitions of all time. If there's probably a couple more we should add into this chart, but regardless, you can say that Google has had some of the best returns on acquisitions ever. And I think that's true. My question is, how many of these did Sundar actually, have involvement in? And the other thing too is that the price they're paying for Wiz is $32 billion. If you look at the price they paid for Google Maps, it was less than $100 million. If you look at the price they paid for YouTube, it was $1.6 billion. If you look at the price they paid for Android, $50 million. Even Google's DoubleClick, which powered their entire search business, was only purchased for $3 billion. So the returns on those acquisitions were so huge, in part because they paid such low prices for them and then turned them into these amazing assets. So you're already paying $32 billion for Wiz. Can you get $160 billion of return off Wiz? I hope so, but that's maybe at best case scenario like a 5x. But these other acquisitions were like 50, 100, 500x because they were bought for such low prices. So I think the price they paid is also a big part of the story. But yeah, I think, I don't know. Google's a really tough one. I think you can probably make money longer term buying it here, but I also think there's a decent chance it has just a chop period for a couple years while it kind of works through the current set of issues. And again, I think I'm still not sure that the CEO that Google has now is the right one. Maybe I'm being a little too harsh, but yeah, I don't know. Google's definitely tough. Like, I want to own some, especially because they own YouTube and Waymo, which are my favorite assets that they own right now besides their core business. But And I do use Google Cloud, actually. I've got a big database of stock prices and stock fundamentals I use on Google BigQuery. And it's a decent product. So I do like Google Cloud, and it's probably a good asset for them long term as well if they don't overspend on stuff. But the search business is still the big profit driver, and that's where it's like, I don't know. What does the future look like for that? There are a lot bigger, longer term questions for that are harder to answer. So I think you do have to be very price sensitive on Google. Yeah, Google Colab, Google Notebook LM as well has gotten really good. I did a let's see if I can pull it up. I did like a summary the other day. I put in the Scott Bessent interview and got like a summary out in PDF in like 1 minute, and it was really good from Notebook LM. Let's see if I can find it here. Yeah, it was like this guy right here. Can y'all see this? I think you can see this. So basically, I just put in a YouTube link. I just put in the YouTube link for the Scott Bessent interview. It used it as a source and then gave me like a big deep dive explanation of all the key points made in the podcast. Because I had listened to the podcast at like 2x speed when I was working out. And then I wanted to go back to it and look through the notes and make sure that I was getting all the points that I wanted to out of it to fully understand it. And Notebook LM gave me a really, really nice output summary of it. And I shared that with the members of our community as well. Netflix. Yeah, Netflix I want to be cheaper, honestly. Netflix isn't as cheap as the other ones. It's got a lot of momentum, but I don't know why it pulled up Electronic Arts here, but let's look at Netflix. Netflix, yeah, it just hasn't sold off enough for me yet, given where some of these other stocks are. I mean, like I look at even things like Square and PayPal, or Block and PayPal, which are now trading both at like 12 times earnings. Netflix is growing a little bit faster and probably is a little bit more durable in terms of its moat, but I think they're going to start to slow down a lot, especially with competition in streaming. You got a lot of the Apple shows are killing it. Max is starting to produce really good content. You've got, I think Netflix is still best in class in terms of streaming, and they've certainly got the best business model in streaming by far. Like the other companies are still struggling to get to profitability, which is kind of insane. It's like they're all just sort of like screwing it up for the most part, except for maybe Apple. But yeah, I mean, but it trades for 30 times next year's earnings. And so are some people going to cancel subscriptions if we get into a recessionary environment? That's a risk. I think you just want to own it at a cheaper price. I think you want to give yourself a little bit more margin of safety to buy Netflix at, say, 20 or 25 times earnings is a much, I think, better place to buy it. Especially if you've seen what happens time and time again with Netflix. When subscriber growth inevitably slows down again, which has happened like several times in Netflix's life. Like it happened early on, back in the early days before Netflix was making a ton of original content. It had a 75% sell-off in a matter of months because there was a lot of concern they were going to lose like their third-party content or have to pay too much for it. Then they started making their own content. Netflix went on a tear. Then, of course, it had like some pullbacks a couple of years ago. It had that massive sell-off in the post-COVID period where, they grew really fast during COVID, and then all of a sudden they hit a wall and they stopped growing subscribers for a few quarters because, they had grown so much during COVID. It was really hard for them to keep accelerating subscriber growth once people started going outside of their homes again. And so they hit a subscriber growth wall for a couple quarters, and the stock got absolutely pummeled. It went down like, again, 70%. And then, of course, we were actually buying some of it, and I sold it way too early. I sold it after like a 2 or 3x, but I was buying some. I had a podcast at the time called Stocks and Coffee that I talked about it on a little bit. But the big unlock for Netflix during this period when it went down like this, the big unlock was rolling out their free ad-supported versions and then also cracking down on password sharing. And so they did a really good job of adding subscribers by having the free tier that they launched with ads, which of course they're getting paid by ads. So it's either you pay for the subscription or you pay via watching ads, and Netflix figured out you could do both. So they increased subscriber growth again by adding the subscription or the free ad tiers, and then they also increased subscriptions by getting a lot of the people that were sharing their passwords with other people to pay a little bit for those people who were using their passwords, and so that unlocked subscriber growth again. And the stock took off from, what was it, like I think $150, $200 stock, and now it hit 1,000 earlier in the year, so it went up 5x. And I think inevitably too, Netflix will hit a slowdown again in subscriber growth, and so that's when the stock tends to re-rate from 35, 40 times earnings. It'll re-rate back down to 20 times earnings because the market will think, oh, it's not going to grow anymore, blah, 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 blah. And then, of course, Netflix will inevitably figure out how to raise prices or grow subscribers again, or increase the monetization that it has on subscribers in other countries and things like that, and adding more content, adding more features. And so, yeah, I think you just want to be price sensitive with Netflix and probably buy it at 20 or 25 times earnings or even lower. And then it works out fine. But buying it at 35 times earnings, I think you just don't have a margin of safety there in case the subscriber growth slows down. Oh yeah, thanks Justin, I appreciate it. Yeah, and you want to talk PayPal? I could talk PayPal all day. You can go look on the channel. I did a video about PayPal, like, I don't know, what was it, 2 years ago, where I did a pretty deep dive on it, and not a lot has actually changed since then, other than the new CEO is further along in pursuing his plan to kind of reinvigorate the business and reinvigorate growth. And growth is not super strong right now, I'll be honest. And if you go into recession, payment volume will slow down, and PayPal might struggle to grow again during a recession. So that's probably why the stock's down. Another issue, of course, is that you have pretty hefty competition in the payment space. You've got Apple Pay taking some share of payments on mobile. On the flip side, you have a lot of opportunities with PayPal, like Venmo. Venmo is still an asset that's doing really well for PayPal, including on mobile, and they're starting to figure out ways to monetize it at a higher rate. So Venmo revenue growth is actually accelerating, and that's a real nice bright spot in the business that I don't think the company is really getting credit for. The other part of the business, of course, is Braintree, which is the B2B processor. So they provide processing for companies like Uber and Airbnb and other large companies, Live Nation, they provide processing for. So the Braintree business, I said back in that video I did a couple years ago, if you look at the values of some of their competitors like Adyen and Stripe, which is private, but if you look at the private rounds and how Stripe is valued in the private rounds recently, and you apply even a discounted valuation to Braintree, a standalone, if you were to spin that out of PayPal and it was its own business, like trading like Adyen, for instance, Braintree would have a value that might even be as high as like half or even as much as the total market cap of PayPal today if it was valued anywhere close to its competitor peers. So you have all these assets within the core PayPal like Venmo and Braintree that I think are really intriguing that aren't getting enough credit from a valuation perspective. Now, the core PayPal payments business, the P2P, the using PayPal to pay for stuff on websites, that business inevitably, slowed down. And again, losing some share on mobile to companies like Apple Pay, losing some share to like Shopify checkout on a lot of retailers. And that headwind continues. And that's why I think the core business has just not struggled it hasn't grown in the last couple of years very much. It's grown maybe at like 3 or 4% in terms of transaction dollars just this past year. But to PayPal's credit, they decided, okay, we're going to cut a bunch of operating expenses. We're going to improve our margins, improve our cash flows while we work on monetizing Venmo, monetizing Braintree, and we're also going to try to stave off the competitive threat in the core business, the core PayPal business, by going after small business volumes more aggressively, by making our checkout faster so that it can compete with Shopify checkout. We're going to offer advertising opportunities for businesses via PayPal. So they're trying to unlock growth even in the core business through these product enhancements. And it's still pretty early on. I think they're starting to see a little bit of progress, and that could be offset by a recession. If all payment volumes go down, that's of course a concern. However, the reality is a recession aside, I think the core business can grow at least like a 3 to 5% rate. I really do think the product enhancements in the core business inflation is also something that helps PayPal grow. As the total volume of spending rises in an economy, they are a natural beneficiary of inflation as well. And so the core business, even if it just is flat, it could probably grow at 3% just based on the inflation rate in the global economy. So I think the core business can grow at some boring rate, assuming, again, excluding recessions. I think the boring core business could grow at least 3 to 5%. Then you throw on faster growth rates in Venmo and Braintree, which are smaller parts of the business. But overall, I think you can get to a growth rate of, again, they did 7%. They grew revenue 7% last year. I think that's a pretty good baseline for what they can grow at on an ongoing basis outside of recession. And then if you're diligent on your expenses and you continue to cut expenses, I think they can grow earnings per share at like 10 or 12% a year. So revenues grow, let's say 6 or 7% a year. Not that sexy, but you continue to have bottom line operating leverage. Last year they grew non-GAAP EPS by 21%. I think they could probably do 10 to 12% sustainable earnings per share growth. They also are doing share buybacks at a cheap valuation multiple. That also decreases your share count and increases your earnings growth. So if we look, I think analysts have it estimated at like 8 or 10% earnings growth kind of longer term. Yeah, I mean like 8% this year, 12% next year, 14% is probably too aggressive. But let's just say they grow like 8 to 12, somewhere between 8 to 12. Let's call it an average of 10%. Again, outside a recession, excluding like a recessionary type of environment. On a normalized basis, if PayPal can grow earnings at 8 to 10%, then I think the shares can do even better than that on an annual basis because you're trading at a 12 times earnings multiple. It probably should trade up at like a 16 to 18 times earnings multiple. So I think you can get a 50% increase in the stock price just from the multiple slowly re-rating higher. And then you throw on top your 8 to 10% compound annual growth rate of earnings. And I think that's where you can start to see PayPal, fair value closer to like $100 to $120 a share today. And then, of course, it can grow longer term above that. But it's trading down, with the rest of tech and with the rest of the market. But 12 times earnings is a valuation multiple that's at a 50% discount to the overall U.S. market. And it also is basically an earnings multiple that reflects 0% earnings growth long term. So if you look at like valuation models, I could pull one up right now, but like if you look at things like the Gordon growth discount model, or you look at a DCF model, and you basically price a company to grow at the rate of inflation over time, the multiple that the model will typically spit out is around like 10 or 12 times earnings. And we're already trading there at PayPal. So the market is basically saying that PayPal is never going to grow again. And I just don't think that is correct. So I think PayPal's undervalued. I bought a little bit today. Let's see. How much did I buy? In the 100K portfolio today, I only bought 10 shares today. So I only added a little bit to the position. Right now today, it's at about a 3% position size. So it's still pretty small. But if it gets into the 50s, I buy more. If it hits new fresh lows, I buy more. And that can be a core position size for me, probably somewhere between 5 and 10% at some point. That would be basically what I'd be looking to take PayPal up to. Do you want me to show you the 100K portfolio right now? Let's just pull it in. Let me see if I can pull this in real quick. I'm going to have to switch to desktop capture. Let's see if I did this right. Can y'all see that? Yeah, I think we can see that. Okay. So you can see here today, let's sort it by market value. Largest position in the portfolio today is about an 8% position in Block, which I find also is very similar to PayPal in a lot of its qualities right now. It's trading for like 12 times earnings. It's actually growing faster than PayPal. It could get hit in a recession as payment volumes decline, but it's it's just too cheap. They're also making a lot of efforts internally to cut costs. Jack Dorsey is cutting headcount finally. He's trying to focus on faster product development, a faster product velocity. So, I think there's a lot to like there. I think the stock's just frankly just far too cheap for a business that I think can be a lot larger in a few years. And then you have some interesting potential opportunities too, like in the crypto side, which maybe today doesn't look as sexy, but there's some interesting things there potentially. There's the core Cash App business. Cash App is kind of the competitor to Venmo, and Block owns that one, and it serves a lower income consumer, but it's got a pretty huge consumer base, a lot of different ways to monetize. It's a great asset, and I don't think it's getting a lot of credit with Square trading for 12 times earnings. So yeah, so I think it's a pretty compelling position, maybe a little bit larger than I'd like it to be today, as I was kind of aggressively buying it a couple weeks ago. But 8% position on XYZ. Coinbase, again, another one I was probably too earlier on. This one was, I thought, I correctly called out that Coinbase was going to smash their Q4 earnings estimates, and that analysts would start raising their guidance on Coinbase. And if you look, that is what's happened. The stock has just not responded positively because Bitcoin prices and crypto prices are down. But if you look at analyst estimates here, since late last year, the analyst earnings estimates for Coinbase have risen from like $4 to $5 a share up to like $7 to $8 a share for the coming years. That's significant. I mean, that's a 50 to 60% increase in the consensus earnings estimates for Coinbase. And typically what would happen for most stocks when you get such a massive increase in earnings estimates is you would see the stock respond positively, but it has not, because Coinbase trades so correlated with just pure crypto prices. So I think longer term Coinbase, their earnings opportunities or earnings growth opportunities are very much still intact. They're still going to long term grow earnings at a nice rate. Maybe they go through a dip if we get a deeper crypto bear market. But I do think Coinbase for longer term earnings power is very underpriced. It may not look as cheap today on this year's earnings estimates if estimates get cut, but I think if you're looking out towards like 2028, 2029, 2030, Coinbase will be a much larger business, and I think the stock will be much higher, and I think it'll get added to the S&P 500 as well in the next 2 years. So that could be a catalyst for Coinbase as well. But yeah, I've been a little slower to add to it lately just because of the market environment we're in. It is levered to overall trading volumes, which can take a hit when we get a volatile environment like this one. And I talked about Wayfair earlier. I've been buying that one pretty aggressively over the last few weeks. It's down 27% today. I think that's pretty overdone. But this is another one where I think this is a longer term position for me. This is not a position I expect to go up tomorrow. It's going to struggle in an environment with high tariffs, but I do think longer term, the earnings power and cash flow power of the business, as they continue to focus on margins and profitability, and they continue to just slowly grow sales. And if the housing market improves, sales will grow even faster. I think they're a long-term share winner in their niche. And I think that on a long-term earnings power for the business, the stock is far too cheap. I think it's trading for like 5 or 6 times what I would consider normalized free cash flow if you're looking out a couple of years. Now, if you're looking at today's estimates, obviously it's not going to look as cheap, but I think we'll look forward in 5 or 10 years and the company will be at a significantly larger market cap. Equinor is kind of my dividend play, cheap energy stock with a nice fat dividend. That one's been doing fine. It's up 15% from cost basis while I continue to clip a 10% dividend. So no changes there. I did buy some Bitcoin in the portfolio recently via IBIT, the IBIT ETF. It's up about 3% from my cost basis. So I bought this when Bitcoin dipped down to, I think, 80 or 81. Just wanted to have a little bit of exposure, scarce asset. I think longer term, good supply dynamics, good supply demand dynamics. It can go through vicious cycles, obviously. It's a position I've still got some room to add to if we do get a nasty, 20, 30% sell off in Bitcoin, as it's often done in the past. But I think supply demand, long term, scarce digital gold. I think it's just a long term. Just hold it in the portfolio, and hopefully you beat inflation by a mile over a long term time frame. TSM, one of the most important companies in the entire world, certainly in the semiconductor industry, trades for like 15 times this year's earnings estimate, something like that. Getting cheaper by the day. OpenAI is out there saying, we can't keep up with demand. Our servers are melting. And yet, like, somehow the AI stocks are all getting massively hit. It's clear even after DeepSeek that there's still so much demand for AI capacity, for chips, for leading edge nodes that TSM provides, and yet it trades now today for less than 15 times earnings. So I think it's a pretty good risk reward. It'd be cool to see like Warren Buffett buy it or whatever, but I don't know if we'll get him in there or not. There is Taiwan risk, but every tech company in the world has Taiwan risk, so I don't think TSM really is unique in that. Talked about PayPal, Tiger is kind of my remaining China play here. It's been up 22% from where I bought it. It's also at one point had a spike above 9. It looked like it was going for $10 a share at the other week when China stocks were hot. It's nice to have a little non-US exposure. I'd like to add some other non-US exposure, maybe in Europe, maybe in Japan. But Chinese stocks have been showing some nice relative strength, so that's good to see. First Solar's been a disaster. I still think this one can be, a $200-$300 stock. They're a beneficiary of tariffs, which is why it's up today, so that's nice. But there's serious risk that if the solar tax credits get cut in the U.S., that their earnings power will decline. But right now, for this year, they're forecasting earnings to grow significantly. So we'll see. I also think solar is the fastest way that a lot of these new AI data centers can add power capacity, and so that's another potential angle here as well. Etsy I've talked about, AMD I've talked about, Uber I've talked about, Abercrombie I was a little early there. It's down huge today with the retail sector as well, but it trades for like 6 times earnings. So I'm kind of just going to hold this position and see what happens. They have been a share gainer and a trend beneficiary in retail over the past 2 years. They have a really good CEO, good balance sheet, buying back stock at these cheap multiples. So I'm cautiously optimistic. Their guidance for 2025 was already pretty low in the first quarter. It was 3 to 5% growth for the year when they've been growing at like 15%. So they were already forecasting a slowdown before we got into the Trump tariff issues. Now maybe they could even shrink a little bit this year, but it's trading for 6 times earnings. So you're just not paying very much at all. And historically, if you look at where A&F has bottomed, it's almost always bottomed at about 6 to 7 times earnings. So I think we're closer to the bottom than we are anywhere else, unless we go into like a Great Depression. So I'm just going to hold A&F for now. Bought a little Micron today. Micron's also very, very cheap. Kind of another semiconductor play. Interesting trend right now. Memory prices are going up. Memory prices are rising. And typically we see Micron correlated with memory prices. The stock has not been trading with memory prices lately because of the fears about AI, because of the fears about tech. So I think right now the market is treating it as like a beta play. But I think as we move later into the year, we'll see Micron's earnings estimates rise. And I think the stock, which is trading for 7 or 8 times earnings, is again a potential double if we remain in a world where AI is important, and I think we will. So I think Micron, it's just too cheap here. And it is a cyclical business in memory, but right now the cycle is turning up. So this is when you typically would want to buy something like Micron, which is cyclical. Deckers, yeah, I don't know about this one. I'm still doing work on this one, but it's trading for 15, 16 times earnings. It's been growing earnings at 20% plus the last couple of years. Hoka is a great brand that they own that's growing super fast. Their core UGG brand has been slowing down, so that's kind of my key worry here. But the stock has basically been down every week for the past like 10 weeks. And I think when you look at metrics like RSI, things like that, it's heavily oversold. And now starting to trade down to valuation multiples that it hasn't traded at in a long time. So you're kind of pricing in a no growth scenario for UGG already. If we go into recession, well, it could have lower to go, but I do think it being down 15 to 20% today is probably a little bit of an overreaction. Airbnb, travel's going to get hit for sure. It's only a 1% position. I want to own this long term, but I think there may be an opportunity to own this a little bit lower to be able to size up the position. I wanted to have a little bit of position in case it ran away from me. They're going to have a big day in May where they unveil some of their new product initiatives. So they're revamping their experiences side of the business. And they're also potentially going to be unveiling some new product initiatives over the next few years that they think has a huge addressable market opportunity. So I'm very interested. I think longer term, Airbnb is going to be a much bigger company in 5 or 10 or 15 years. Like I put this in my kids portfolio and just going to like literally buy and hold that for years and years and years. I think it'll be a much bigger company. The stock could go to 80 in the next few weeks on fears of near-term recession. And if it does, I'll add to the position because I've got a lot more room to add. So I may be a little bit here. I'm probably a little bit early here on Airbnb, but I do want to own it longer term. So it's in this portfolio now as well. So yeah, that's just some of the stuff that's in the 100K portfolio. As of today, cash is still 44% in cash in the portfolio. So Um, yeah, I don't know. It's all right. We're slowly building the portfolio up. It's slowly getting there. It's got some interesting components to it. I would, like I said, like to build out some more non-US exposure as I go forward. So I'm going to be thinking a lot about that. Because I think there's a lot of pent-up demand now for non-US stocks. Even US investors are probably going to start thinking about shifting some allocations here to European stocks and Asian stocks. With the US administration kind of shooting ourselves in the foot economically right now, it seems like a good time to think about where there might be alpha outside the US stock market. Yeah, and we saw, earlier in the year, the European indices year to date still, even after kind of a recent pullback, European stocks are up 12% this year versus, US stocks, which are now down between 8 and 12% on the index basis. So, yeah, that's where we're at. And that is a multi-year trend that could continue if we get a lot of European asset managers reallocating a lot of their exposures from the US back to their own home markets. All right, let me hit some questions. I know y'all have been chatting while I've been just running my mouth, so let's see. Oh, yeah. Tristan said Netflix live stream was horrible for the Tyson fight. Yeah, what was that? If they're going to get big in live events, they have got to do better. Like, I couldn't even watch Jake Paul, Mike Tyson fight. Like, I tried to turn it on, and it never worked. Literally the whole time, the whole fight. At no point did it work for me. So I was like, all right, I guess I'm not watching this. I'm not, like, huge into UFC and fights, but like as a casual viewer, I was going to tune in and I couldn't even watch it. That was a big whiff on Netflix's part. It didn't really seem to affect their subscriber growth in the fourth quarter. I was surprised. I thought a bunch of people might try to cancel their subscriptions or whatever, but it didn't really affect their subscriber growth, at least in the fourth quarter of last year. So I was surprised about that. I don't know. Maybe it just didn't have an effect on the business, but if they're going to grow the live part of the business, they have got to figure that out because like that was not a good consumer experience. Yeah. Oh yeah. Spoon says I can't respect PayPal with the honey shenanigans. Yeah, that was a terrible acquisition. Talk about another M&A that kind of went bad. PayPal bought Honey for what was it, $4 billion, and that was a pretty big multiple at the time. And the idea was that they were gonna use Honey to kind of basically present consumers with all these potential deals and create this like deal platform. And that would also give consumers a reason to use PayPal more for payments. And they never really integrated it properly. And then they ended up writing down the Honey acquisition. Now that was under the prior CEO. So I'm going to give the current CEO, Alex Chris, a little more credit to see, hopefully he can really get these new product enhancements working. And he's not out there making a bunch of dumb acquisitions yet. So I'm hopeful that he is a better CEO than the last one who made the Honey acquisition. But we'll see. Tyler was asking if I prefer PayPal over XYZ. Honestly, PayPal is going to be, I think, lower risk, lower reward. So you have a component there that, yeah, I think PayPal is less risky than XYZ. But I also think it probably has less longer-term upside. They're both trade around the same valuation, but I think XYZ long-term could maybe grow faster. They're just a little bit more innovative, and they don't have quite as big of a headwind in the core business. They do have a lot of competition, like I know Toast and some of the competitors that compete with like the Square SMB. Like, when you go to a coffee shop and you buy coffee, a lot of times you're paying on a Square terminal. That business has definitely slowed down for Square, and they definitely have significant competition from companies like Toast and other companies in the SMB space. But I do think that's also like a really bright spot for them where they can continue to roll out new features and new ways to monetize. And they can probably, because they're growing from a much smaller base, I think they can still grow that business longer term. And then you look at like something like Cash App, which has got all these users, and there's potentially a lot of different ways that they can monetize it. They could even, there's just, look at what Robinhood is doing right in their app and things like that. There's a lot of different ways I think longer term Square can envision making that more useful and making it a bigger a bigger part of the business. And so I think longer term, like there's still opportunities to grow the core businesses a lot faster. Whereas PayPal's core business, it's like it's really struggling to grow against Shop Pay and Apple Pay and all the things that are these significant competitors. And because the existing PayPal business is already so large. So I think it's just tougher for PayPal to grow. And I think XYZ has some opportunities longer term to grow a little bit faster. And then, of course, they have stuff like the crypto stuff that they're working on that could be revenue generating at some point starting later this year and next year. So there's these like bets that XYZ makes. Now, XYZ also does some really dumb stuff as well. They bought Tidal, which just really seems like Jack was bailing out his buddy Jay-Z. I think they bought Tidal for, I'd have to look again, but I think it was $2 or $3 billion for something that never really took off in a significant way. And so like Jack, when you also look at how he ran Twitter and how Twitter for many years was struggling and under monetized and dealing with employee bloat and all these different things, like Twitter, there was a lot of questions I had about Jack Dorsey's management of Twitter, right? And so when you have Jack Dorsey at the helm of XYZ, there's been some questions there. Like, why did he acquire Tidal? Is he going to run XYZ like he did Twitter, where he's not really focused on a lot of things he needs to be? He's distracted by all these other agendas, right? Right now, though, it looks like Jack is starting to focus in. Like, they released a shareholder letter or a letter the other day to, what was it, employees, where they were like, we're not moving fast enough. We're laying people off. We have to move faster. And I don't think it's on here. Maybe it's... can't remember exactly. Yeah. Okay. Here it was from March 25th. Block laid off 931 people, or roughly 8% of the company's staff. And Dorsey was basically like, we have to do this for strategy and performance. We have to do, where is it? Let's see. Okay, here we go. Here's the letter. And basically he's like, we have to move faster. We're not moving fast enough. We're not even laying off people to hit a financial target. We're doing this because we have to get faster, get better, get more lean, focus on our core core competencies. And so like, yeah, he says we're behind in our actions, and that's not fair to the individuals who work here or the company. When we know we should move, and there hasn't been enough movement, we need to move to help us meet and stay ahead of the transformational moment our industry is in. So that to me is a little bit of a positive sign that maybe Jack is kind of like waking up that, hey, like our share price is down. We haven't had that much innovation lately. The market doesn't believe that we're going to grow super fast in the years ahead. And he's like, look, I gotta make quick changes, and I gotta refocus our team, and I gotta get us moving in the right direction. And so that's at least a small positive in my eyes there. And so again, when I look at like XYZ versus PayPal, I'm like, they're both trading around the same valuation. Which one is going to be a much bigger company in 5 or 10 years? I think XYZ has the potential to grow a lot faster than PayPal, but there's going to be a lot more variability in that, because there's also some ways that they could have some serious missteps and things that they could fumble. Whereas PayPal, the core business, again, probably grows 3 to 5%. Venmo's still severely under monetized. Braintree, even if it stopped growing today, would be a good asset they could spin out or sell to somebody for a higher price than the market has given them credit for. So I don't think there's a ton of downside with PayPal necessarily, but the real question is, how high can it go? How fast can it grow? So PayPal, I think, has a lower floor, or a higher floor, but maybe a lower ceiling, if that makes sense. So they're just kind of a different risk reward to me in my mind. And so it really is a question of like, how much risk do you want to take for the upside? And I like them both. They're just a little bit different in terms of that risk reward ratio. That's how I see it anyway. I mean, I don't know. Tyler, yeah, you're asking about if my cash is in bonds. So in brokerages like Interactive Brokers, or I think Fidelity as well, they automatically roll your cash into yielding instruments. So they typically will have it in like money market instruments. So in those cases, yes, I'm basically just in short-term money markets, earning like roughly 4% annually right now on the cash. In other cases, in other brokerage accounts, I have to proactively go either buy a money market fund. I do own some shorter-term bonds, so I own some like 2-year bonds. I don't really own any long-term bonds right now. I don't own TLT. I know that's been a nice hedge for some people that's done pretty well recently, but I just don't want to take 30-year credit risk on the U.S. government. You're not earning that much yield above. You're starting to get a little bit more yield spread here, but 4.5% to hold a 30-year bond versus, just recently we were still earning 4% on short-term stuff. Now it's a little bit lower, but I didn't really want to take the longer-term duration risk just to earn a tiny bit more yield. Now, if U.S. Treasuries if 30-year bonds start to yield 2 or 3% more than the short-term Treasuries, then yeah, I might think about longer-term bond plays. But right now, I still just like either money markets or very short-term bonds for my cash holdings. Yeah, I guess I'll leave the live video up after the fact. Marco, you were asking if I'm going to keep the video up. It's just me kind of rambling, so I don't know how effective or useful it'll be for people, but yeah, we'll keep it up on the channel. No problem. Bomb Man saying Jack is waking up too late. Yeah, maybe. I don't know. If you look at earnings estimates for XYZ, I mean, XYZ's guidance for the year, they still expect to grow, I think, 10 or 15%? I forget the exact number. Let's look. What was their fourth quarter guidance? And that could come down in a recession, but you've got in the fourth quarter shareholder letter, let's look at their guidance here. Got to scroll all the way down. We expect strong gross profit growth of at least 15% per year. So on a bottom line earnings basis, they can probably grow at least 15% if they're growing gross profit at 15%. Analysts this year, again, before any concerns about recession came out, analysts were expecting them to grow earnings at like 30% this year and 18% next year. So those are pretty high growth rates. I don't know if they're going to hit quite that growth rate. But let's say they can grow earnings 10 or 15% a year for the foreseeable future, and you're only trading at 12 times earnings. I mean, this thing will do just fine in terms of the stock appreciation potential if they can hit those types of numbers. But, recession always throws questions into the mix about, do you go from growing gross profit at 15%, now you're only growing gross profit at, or your gross profit is declining a little bit and your earnings maybe decline a little bit this year instead of growing 30%? That's a pretty big swing. That is certainly possible if we get into a deep enough economic malaise. I think it's a little early to say. Like, looking back here, turning back to the macro here for a second, I know today's really scary. There are a lot of questions. I think, again, the U.S. is shooting themselves in the foot economically in a lot of ways that could be more permanent. But I do think also that we've seen the administration flip-flop. We've seen them use things like the tariff rates as a negotiation tool. We've seen them make quick agreements with countries, get a little bit of concessions, and then completely flip. And then all of a sudden things rally quickly. So I do worry about the longer-term damage they're doing here by injecting all of this uncertainty, and market sell-offs and stuff like that have longer-term consequences sometimes. But there still are scenarios on the table where this kind of works itself out quickly, and maybe the first and second quarter look weak, but then we start growing again by later in the year. So that's certainly a possibility as well, that this thing can flip around pretty quickly and we can go from being in a very pessimistic market environment to a very optimistic market environment. I still think the Trump administration, despite what they're doing lately, I still think they very much care about the business community. I think they very much care about how the stock market does during their term long term. They might not care what the stock market does this week or this month, but I guarantee you that Bessent and Trump don't want to leave a legacy of having a stock market collapse on their hands during their term. One, because of their legacy, but also because it's their own party, the Republican Party, are going to get creamed in the midterms and in the next election if they're, if the economy tanks during their administration. So I think they have plenty of incentives still to turn things around, but we could be in for a bit of pain here still in the near term. And what we were talking about in our skill incubator community recently, our wealth incubator community as it's now called actually, the 2018 sell-off in markets, I don't know how many of you were around for this or remember this, but in the fall of 2018, this was during the first Trump administration, and this was mainly an issue with concerns about the Fed and raising rates too fast, but there was also some Trump administration stuff in there too. but we had a 20% sell-off in the S&P from basically September through the end of the year. And we bottomed, I think, on either Christmas Eve or a couple days after Christmas Eve in 2018. And this was peak to trough, about a 20% sell-off in the S&P. And there were stocks that were down 30, 40, 50% during this time frame, including some of the Mag 7. So I think we could see a similar thing here where we had an initial move down, we chopped around, and then we had the kind of second wave of selling pressure that was more intense. And then we had a V-bottom bounce after the Fed backed off and realized, hey, we can't keep raising rates so aggressively or we're going to kill the economy. And I think a similar thing could happen here in what we're seeing today with the tariff issues, and we could have markets go down further. You know, we're down between 8 and 12%, depending on which U.S. index you're using, the S&P or the NASDAQ. I think ultimately we could end down easily in a 15 to 20% market correction before we get some strong enough reactions from the administration and the current the current Republican Party in trying to reverse some of the policies that are causing all of this heartache and heartburn. And so I think, that could be what we see play out here. I mean, I could very well see this, and maybe even a little deeper than last time, maybe even a little deeper than 2018. But the markets like to take this elevator down action, and then it's, a slow stair step back up. So that's why I am deploying capital on a day like today. I won't nail the exact bottom, and there could be further downside to go on the market and certainly on certain individual stocks. But when you're buying cheap enough stocks at already cheap valuations, even if things get really bad, and you're not like losing sight of your risk management on your portfolio, then typically these times where you have these fast washouts of 15 or 20% on the indices tend to be pretty good opportunities for accumulating cheap positions that set you up for really good returns when we do get a bounce in the market, a more sustained bounce. Marco's asking about Lulu. Yeah, so Lulu, another stock that's starting to get optically cheap. They reported earnings a few days back. This stock hasn't been this cheap in a while. There are some concerns that they're starting to lose share to some of the other athleisure players like Athleta, Alo, I don't know exactly how you say it, but like basically the brand that's like Gen Z's favorite athleisure brand right now is Alo. Vori is another one. Vori's been gaining some share. They've been opening brick and mortars and starting to gain share in athleisure and performance apparel. So Lulu's not the only game in town anymore. And I think that ultimately does affect our perception of how fast Lulu can grow. I think the days where Lulu grows at 15 to 20% a year for the foreseeable future may be over, but I don't think it means they can't grow at all, because I think one of the big bright spots for Lulu, and Nikki Dunn, CFP, who's in the chat and also in our Wealth Incubator community, she's tracked this stock for a long time, but she's also traded it super, super well. But one of the big potential bull cases here longer term is that Lulu is aggressively expanding internationally. And this is an area where Lulu is still very underpenetrated and is still very much an aspirational brand that is doing very, very well in its international markets. And so that's where I think the growth will come for Lulu, even as domestic slows down, as they start to lose some trends and start to lose some market share against your Alos and your Athletas. And your Voris of the world here, which are obviously making some pretty good apparel and kind of copying Lulu in certain ways, maybe even outcompeting Lulu in certain areas. But, I think Lulu's numbers are still good, and I think internationally is the big opportunity for them. And so I still think, unless they have a huge misstep in terms of their merchandising and they really start to lose the market share in a faster way, then, assuming that doesn't happen, assuming they don't do something totally boneheaded to blow up the brand, I think they can grow. Net revenue grew in the fourth quarter by 13%, 14% excluding currency effects. And typically they should be able to grow the bottom line a little bit faster than the revenue growth line if they can keep expenses in check and buy back stock at cheap prices. So, that was a pretty good growth rate, still growing at a low teens growth rate. Now, if we go into recession, just like every other retailer, they're going to slow down and potentially even see a sales decline in the short run. So I try to think about, what does the normalized growth rate look like long term? Where can you defend it even on a short term price basis? Like, if it trades down to say, like, let's say you cut their earnings estimates this year and it trades down to like 15 times a lower earnings estimate, that's a place where I think you could easily start buying it, knowing that you're buying it at a comfortable place for kind of a long-term accumulation opportunity. So right now they're forecasting only 6 to 7% growth for the year, and that's because Q1 started out slow and they're being conservative. And even though they grew 14% in the fourth quarter, they may have some deeper headwinds to growth this year. And so let's say they don't grow at all this year. Let's say earnings, they put in earnings last year of basically just over $6. Let's say they can just hold the line and do $6 of earnings this year. You're trading for 254, so I'm not even going to do the math in my head. We'll use a calculator. You're trading for like 40 times annual earnings. Now, I think is that an adjusted number? Oh, no, that was just fourth quarter earnings. Sorry. So for the full year, no, I was wrong on that. My bad. For the full year, they did 1460 in earnings. So again, let's redo these numbers. So let's say they did $14 in earnings for this year. Let's say they can not grow earnings, but they can hold it flat. Then you're trading at 18 times, which is a fairly cheap multiple longer term for Lulu, which is tended to trade at a premium to the overall market. Now, maybe it's a little bit worse than that. Maybe you want to have a little bit of margin of safety, and you assume we are going into recession, and so you are assuming that we do a little bit worse on earnings. Let's say short-term earnings go down to like $12 a share. Okay, so let's say $12 a share of earnings means that today it's trading at 21 times a revised recession earnings estimate. Well, if you go back and you look at some of these tougher periods for Lulu, it traded down 21 times here. Mid last year during the yen crisis, traded for 17 times. During its brand issues a number of years back, or during the GFC, it maybe traded, it actually traded down in the GFC closer to like 10 or 11 times earnings. But assuming we stay out of an environment like that, it tends to bottom, right around that like 20 times earnings level, or maybe a little bit, maybe a couple multiple points below. And I think that's a pretty reasonable place, unless you get a brand blow up. This thing's not going to trade for 8 times earnings, I don't think. Now, it could easily trade for 14 or 15 times a recession earnings estimate. So I think if you wanted to give yourself a margin of safety, let's say, let's call it like 175-ish is probably a good defensible range for Lulu if you wanted to get really conservative and have a really nice margin of safety. And that's actually where it traded down in COVID. It traded down to a low around 160, maybe even a little bit lower than that intraday. And I think that's definitely, and the business has grown since then. So if it traded back down to like 160, 175, that's actually a lower valuation, significantly lower valuation than you had back in COVID. So that'd be a very margin of safety level. For me, I'd probably want to start nibbling a little bit before that. Now, you may have some technical support here at the prior low from last year around 220-ish, 225 on a shorter term basis as well. So if you're looking for like a bounce play, that could also be an area where you look. I think retailers are going to be a little bit out of favor right now, unless you get like a quick flip back into a bull market. If like they just decide not to do the tariffs at all and the whole thing turns around quickly. I don't expect that to happen. I think retailers are going to be a tough play right now. So I think you do want to be slow to kind of DCA in if you are going to add positions in retailers, just because they're going to be so economically sensitive that all this tariff headline back and forth is going to create opportunities for them to trade down. So yeah, maybe 175 is too conservative, but I think that would kind of be the no-brainer level for me for Lulu. It's starting to look cheap here for sure. I mean, on current estimates, it's trading for what looks like it's 16 or 17 times where it's tended to bottom before. But I do think if earnings estimates get cut from here, that's where you have further downside. So, call it like low 200s and then sub 200. I think it really starts to get very, very intriguing. And I think if your belief is that we're just in this tariff nonsense for just a couple of days or a couple of weeks, then even these prices today, I think, could be buying opportunities. But where I'm at with just trying to add a little bit of margin of safety on some of these things, especially economically sensitive things like a retailer, I mean, look, you can buy Abercrombie for 6 times earnings, and so I don't think Lulu is going to trade for 6 times, but I do think like if you're trying to give yourself a little more margin of safety here, then I think adjusting your earnings estimates downward a little bit and then putting a historically low multiple on it kind of gets you to that margin of safety level where it gets a lot more defensible and you can step in and buy and be a little bit more confident about it. So, so yeah, it does look cheap on today's numbers, but if we cut today's numbers a little bit, I think you still want a little bit, maybe just a little bit further down. Maybe that 220 area and below is where you start to like nibble, at least for me. Because it's not like, it's not like there aren't some questions about the competition and some of the core business already slowing down pre-Trump tariff nonsense. It's like, you've already got some kind of noise out there about Vori and Alo and all these brands that are starting to kind of come for Lulu's market. That's another thing that you might want to play for a little bit more margin of safety on. I don't know. I would love to hear Nikki's opinion, though. She may be buying this today, and I tend to follow her lead on some of the retail stuff. All right, let's just take a quick look in. I'm probably going to wrap up and do lunch here pretty soon, but looks like, market's still pretty weak overall here. We've got the NASDAQ still off 4.5, the Russell still off over 5.5. So we got a little bit of an intraday rally, and it looks like it's kind of given back some of that. So it's going to end up being a pretty rough one, I think, out there today. I haven't checked in on the headlines to see what else we're dealing with here. All right, maybe we wrap there then. Maybe we wrap there. I know I was just kind of running through a ton of different stuff today. I was already working on content for a recorded video that I wanted to do and put out today or tomorrow. So I'll probably still do that, but just wanted to do the live to just connect with everybody and just chat different stocks and tell you what I'm thinking and kind of give you an update on where I'm at. So, just to kind of recap, like I'm definitely buying the dip, but slowly. And still have a lot of cash in the portfolio to deploy, thankfully. So just going to be slow and methodical about that. And I do think opportunities are emerging with some of these pretty steep sell-offs, but we do have significant risk here with kind of a worst case scenario on the table on the tariff side, with the U.S. making a lot of moves that I think are questionable, damaging our own credibility, damaging our own standing in the global sphere. Even if it has goals that I think are the right goals longer term, the way that it's being handled is pretty haphazard and chaotic. I think we can all agree on that, right? But sometimes chaos and volatility is good. Believe it or not, in the markets, like chaos and opportunity like coincide a lot of times. I mean, if you think back, like it's hard to remember how we felt back in the depths of 2020, or even back in like August last year when we had the yen carry trade reversal, or even back in the fall of 2018. I guarantee you most people probably don't remember how bad it felt in the month of like November and December back in 2018 and how hard it was for a lot of people to be buying this dip back here. This was a significant fast sell-off, but ultimately it worked out, as these dips tend to do longer term. All right, everyone. Well, I'm going to have some lunch, have a breather, but y'all let me know if you got other questions, other things you want to see me cover. We'll maybe either do another live, or certainly I'm going to try to work on some recorded content for the channel. I've had a lot going on this month, but I've got a lot of stuff in the hopper, and I'm also going to be, so we're doing a live boot camp sometime in the summer. The waiting list for that is in the description. I'll be announcing more details on that soon. I'm also looking to potentially do some more content here on YouTube, testing out the subscriber feature. So I'll be talking more about that, but I may do some more in-depth stock breakdown videos for people that want to that are interested in that maybe want to throw a few bucks my way on the YouTube subscriber side. I want to play around with the subscriber model here on YouTube and see how that goes. So I'll still have a lot of free stuff as well, but I'm going to maybe test that out and see if that's fun and see if that's useful for people. And then, of course, we have our wealth incubator community as well, which you can find a link to in the description. And that's if you're a more active investor and active trader and want to be in it with us daily in Discord, go into our market update classes, doing our monthly classes that we hold for different topics, and going through our courses and things like that we have. We have a ton of resources for people just around managing wealth and investing in stocks and crypto. So that may be for you if you're a super active investor who is doing a lot of stuff on a day-to-day basis. So we love our community. But yeah, Marius, we'll talk NVIDIA. We'll talk NVIDIA on another update. I think NVIDIA is probably fairly interesting as well. But yeah, we'll leave it at that. All right, everyone. Well, thanks for joining today. I'll see y'all soon. Cheers.